Oliver, how to know if pullbacks after how to know if pullbacks after elephant bars are viable? Typically, let me do this again. I'll do this again. I'll bring you to. Ooh, what was that alert? I will bring you to. Let's see here. Full screen. So I'm going to just draw here. All right. So let's say, for instance, you're getting this power bar surge off the 200. And typically, and let's say it starts pulling back from here. Now, typically you want it to hold the halfway mark. That is your healthiest. Okay? That is your healthiest when it holds the halfway mark. When you start to break down this halfway mark, if you lose about 80% of it, you have to assume that this bar has failed. All right? And certainly if the entire bar has been taken away by the drop, it's over. But the 80% of it is enough, actually. All right? And so the best scenarios hold the 50%, but that's in anything, guys. That's in anything. So you see this run up here? You see this pullback? Now this is the halfway mark. This held the top, right? If it broke down here, it's likely to do something like that. So as you can see, when you finally, it's the move after every pause. So there's a pause and then there's the next move. Now here's the halfway mark of that. When you break that halfway mark, it's over from there. Now, if you look at the move all the way down, check this out. Watch this. You've got this move from here. So we drop and then we go here. We don't violate the halfway mark there. We drop here. Let me show you this. So we drop from here to there. Now, what's the halfway mark? About right there. We bounce up to the halfway mark and drop. Now, let's take the halfway mark here. We bounce up to the halfway mark and we drop. Now, let's take the halfway mark here. We bounce up to the halfway mark and we drop. You see? Now, let's take this. You see this drop? Now, where's the halfway mark there? But this breaks it. So now, that's your potential bottom. See? The first time the halfway mark was broken, we haven't really seen any significant lower pricing. And so this is the case in multiple bar runs. It's also the case in a single bar run where you cut that in half. And if your stock starts pulling back on you, you want that to hold the top half. All right? I hope that helps. All right. Where would you guys be with me? No, I'm only teasing. Well, kind of. All right. All right. I'll take one more, guys. One more. Let's do this. Let's do this. All right. So I'll take John. John came in a little late, but I'll take his question. John Costello's asking, I tuned in late, so you probably already talked about this, but I didn't. That's why I'm taking it. But do you think that a market crash will happen in the near future? Well, John, you know, everyone, anything is possible. And we are in uncharted territory. I did mention earlier that no one has seen this confluence of events all come together at the same time like this ever in history. We've read about these scenarios individually, and some of the scenarios that we're dealing with now, we've experienced. I've experienced a bear market before, but I've never experienced a scenario where we have a freaking war that can truly ignite into the destruction of the entire planet. We have just come off of a global pandemic. We have experienced the highest inflation in 50 years. We've got China going into a lockdown again, which can further disrupt the troublesome supply chain. It's so much uncertainty, and we have experienced a scenario in which there was so much liquidity in the market that all assets, all paper assets, rose to ridiculous valuations. And so all cycles reverse. Could we be in for a crash? Maybe. But I will tell you this. Many things have already crashed. Let me show you this. This is important. A lot of people tend to miss these things, but we have already crashed. Do you understand? So take a look at this. Take a look at this for a second. So take a look at this. We were just looking at Mara. This is what percentage of a crash? 85 to 18. What percentage is that? It's freaking crazy, right? Let's take a look at Facebook. And let's look at it from this perspective. Now look at this, guys. Let's look at Meta. All right? Now take a look at this. This is pre-COVID. That's before COVID. We're under. This is billions upon billions of dollars that have crashed. Okay? Liquidity has been removed from the system. Okay, take a look at this. You can take a look at something like Peloton, of course. Look at this. Pre-COVID, we are under. Look at billions upon billions of dollars out of the system. That's called a crash. Do you understand? We can go on and on and on with this, right? Baba, pre-COVID, below, out of the system. You know, and it's, you know, it's just all over the place. What's Netflix? Yeah, NFLX, right? Pre-COVID. Billions upon billions of dollars out. So this has happened already to many, many, many things. And what's amazing is that when you look at these things like this, and then you look at BTC, you see pre-COVID here. What's done better? Meta, Baba, Netflix, Peloton, PayPal, Square, Twitter. What? What's done better? This is held up better than almost everything out there. Do you understand what I'm saying? And so you've got to put things in perspective. So people say, I don't see how Bitcoin's a store of value. What are you talking about? Look at all this destroyed value. Look at PayPal's destroyed value. What are you talking about? There's pre-COVID right there. That's not a store of value. This has stored the value. You know, this has done it. That has done it. Boom. Look at that thing go. You understand? So you've got to be able to put things in perspective. And the way you're supposed to look at this is you're supposed to look at this on a logarithmic scale. So now look at how it's retained its value. This is pre-COVID. And all this is, guys, I'm telling you, all this is, watch this, I'm going to show you. All this is another one of these. Look. It's just happening at a higher rate. It always happens at a higher rate. And the doubting happens here until this. And the doubting happens here until that. And on and on and on we go. You know what I'm saying? So my point is, in response to your question, is that we have already crashed. So the question is, can we have more of a crash? Yes, but we can. But I want you to think about this, because I think this is important. This is how I want you to think. If something, remember I told you to cut everything in half. So if a stock has moved, right? Let's say a stock has moved from, let's just make it easy, 0 to 100. Where's the halfway point? 50. Now, the stock has moved from 0 to 100. It's now at 30, right? Can you lose as much as you lost? No. Does that make sense? Like if a stock has gone from 0 to 100 and 50 is the halfway mark, and you're now at 30, you've lost $80. Can you lose another 80? No. So what's better to do down there? If you like it, start accumulating. Use the declines to pick up cheap inventory, because you're now mathematically at a place where your downside potential is smaller than your upside reward. Now, let's take it further. You got something that's gone from 0 to 100. The halfway is 50. It's now 30, which means that you've got 30 points to 0. But what's the odds of a multi-billion-dollar organization going to 0? Not very high. So going to 5, not very high. Going to 10, okay, maybe, but 15, okay, now better. So now, okay, get to that price where I can maybe see another 50% from 30 to 15. So now you make 30 to 15 your accumulation zone, and you divide that accumulation zone into 3 parts. So the top third, you start accumulating light. You get into that middle third, you accumulate medium, and then that bottom third, you start picking up the size of your accumulation, and you accumulate in zones. You don't play like a freaking ABC kindergarten. Oh, I'm going to put everything in at this price and hope I hope I pick the right price. There's a million prices out there, but I'm going to only choose one. That's not how you play. That's not how you accumulate for wealth, you know? You've got to accumulate ranges. You sell ranges and you buy ranges. But you've got to be able to come up with what's a range that has limited downside. And that's how you do it. All right? So if we take this to Bitcoin. Bitcoin's 69. It dropped to 36. All right. Now, could it drop to 0 from there? No. Back to 10? I doubt it. I doubt it. That's very unlikely. 20? All right. Okay. 25 more like it. So now I've got my accumulation zone, right? I'm at 36 and 25. That seems like a good accumulation zone. So now I'm going to place orders down that zone. You understand? And I'm going to start off light at the top, medium in the middle, and heavy toward the bottom of it. That's how you do this professionally. You get to a place where you see limited downside compared to the upside, and then you create an accumulation plan and you stage in. You don't have singular price risk, you have zone risk. And this spreads your risk out over a wider zone, which is a safer way to play the game.